bank deposits in the country, it appears that people's trust in banks is at an all-time high and in fact growing annually at a compound interest rate of 9.5%. That according to the bank deposits figures as of 2023, which are currently touching about 200 lakh crore rupees from 100 lakh crore rupees in September of 2016. So from 2016 to 2023, doubling of that amount. What does it really mean?
It means a lot of things, Shweta. I think number one, it means early this year we were celebrating the AUM of mutual funds at 50 lakh crore rupees and we were saying, whoa, wow, you know, this is a big number. Compare this to bank deposits at 200 lakh crore rupees, we are talking about a 4x.
Number.
We are talking about a 4x quantum of bank deposits versus mutual funds. And mutual fund investments see investments like from across the board, not just retail investors or retail savers, but even institutional savers, global folks, etc. Everybody takes part in the mutual fund growth story, and that at 50 lakh crore rupees was like the biggest headline. But bank deposits at 200 lakh crores is 4 times that.
Absolutely.
So I think what it basically tells you is that people who want to park their money are still a little more sure and a little more confident of the banking ecosystem and a little more risk averse. So I think this whole concept of financialization of savings, which everybody was talking about and the world was very bullish about in the year 2020, 2021, and that really saw the momentum in Indian markets, the retail investor participation in Indian markets did tell a story of its own, but only to a point where I think people do not want to shy away from fixed deposits. Now, if you look at the year 2023 alone, the deposits, the AUM of fresh deposits that came into banks was at about 12.6 lakh crore rupees. Compare this to the additional AUM for mutual funds at 1.2 lakh crore rupees. It means that in the year 2023 alone, bank deposits saw 10x more growth than mutual funds.
Right.
I think some of this is also to do with the fact that markets in 2023 had been a little volatile. We didn't see the IT sector firing, we didn't see the blue chips and the large indices like Nifty 50, Sensex, etc. give the kind of obvious returns that that they did give in the pandemic struck 2020, 2021, 2022. And the small cap rally, which in any case is seen as volatile and not suggested by most investment advisors, made some retail investors perhaps shy away from this whole mutual fund game, or if not shy away, not participate in as much measure, because we also saw that 2022 is when inflation started hitting and bank interest rates started going up. So there was a surety of a 7%, 7.5% return if you parked your money in banks in 2023. As opposed to a volatile scenario where you may get upwards of 10%, 12%, but nobody knew the downside given that there were 2 wars on in 2023. So I think 2023, the story was more to do with high interest rates and surety of income. But overall, 2016 onwards, bank deposits doubling. From the year 1997, I think bank deposits were just at about 5 lakh crore rupees or so. It's gone up 20 times in the last 25 odd years. So overall, I think bank deposits, fixed deposits are something that Indians are very, very heavily invested in emotionally and financially.
You know, let's also take a minute to understand the growth trajectory of the mutual fund industry. At 50 lakh crore rupees at the moment, it added 10 lakh crore only in the year 2023, which is a massive addition. If you were to extrapolate that number over the next 4 or 5 years, would it ever match up? Would people be investing perhaps equally, depositing as much money in banks as they're investing in mutual funds? It does look like there is more and renewed interest towards mutual funds.
I mean, I think a lot depends on what is going to happen in the world in the next 5 years, Shweta. So, we can't really sit here and crystal ball gaze right now. But if we were to do that, if we were compelled to do that, I think let's look at the drivers which are going to influence the decision towards bank deposits or markets. So, I think the number one scenario would be that if interest rates continue to be high and RBI or central banks across the world are unable to cut rates, then banks are going to give short returns, which is going to ensure that debt instruments are going to be more favorable because you don't know the kind of volatility which is going to hit equity. If wars continue, then that scenario is likely to happen for longer because supply chains are going to continue to be hit. Now, in the other case, if you see that that there is discretionary spending, companies are doing well, demand is going up, profitability is rising, possibility of a rate cut, then you will see people will want to buy, participate into companies and their growth stories. And if that happens, markets are going to rally. So overall, I think, it's difficult to look at past data and draw a very, very clear picture of what is going to happen in the future, because investors, savers are fairly smart. They will see how the world is panning out for them and what is going to give them less risk, more return, if that is ever possible, and opt for an option which gives them that balance where there is some assured return, or there is a less likelihood of money being lost and a greater chance of fixed money or sure money being made. And that is where they're going to park their savings stroke investments as we see them.
Okay, and you're talking about smart investors, investors who are perhaps more financially literate. For people who still don't trust mutual funds as much, I think there is a renewed interest towards mutual funds. There's a sense of trust building up from the data that we can see.
So I don't know, Shweta. I think, it's, again, I think it's easy to sit in the studio and classify people as those who are more educated and understand markets better and those who are not. But I think the reality is that those who have the money have the education, and those who have the education are perhaps fairly self-aware and aware of their financial whereabouts, and are taking very calculated decisions. Those who don't have the education, to my limited understanding,
small savers, people who still invest in post banks,
perhaps don't have enough money,
RDs, FDs,
they don't have enough money to put at risk.
Okay.
So I think they will obviously continue to look at RDs and FDs and post office deposits, because A, they understand those products better, and B, they don't have enough money to put at risk. So if they had the money, then the education would obviously have followed.
Okay, very interesting dichotomy there playing out as far as bank deposits and mutual funds industries is concerned.